session is going to be all about, investing in the industry, looking at the future-facing dynamics, and kind of next steps for the industry. So up here today, I have Scott Clements, Head of Advisory at Tribeca Capital. We have Dinos Demetriades, CFO of Pelagic Resources, Adhita Widiadhari, Senior Consultant at CRU, and YJ Lee, Director at Arcane Capital Advisors. So thanks to my panel for joining me up here today. Maybe to kick things off, if you want to just give like a quick introduction to yourselves, and then we can kind of dig into the questions. So Scott, starting with you.
Sure. Good morning, everyone. So I'm based here in Singapore. I work for Tribeca. We're a fund advisory wealth management firm. It's been around for 25 years. Started in Sydney. We have a couple of funds we manage out of Singapore, and in Australia we manage a number of Australian public equity strategies and global natural resource funds. I run our corporate advisory business, and we also have a private wealth group in Australia. I've been here in Singapore for 20 years, and it's nice to have the one-to-one guys back again. Thanks, Amy.
Hi, good morning, everyone. I'm Dinos Demetriades. I'm the CFO of Pelagic Resources. We're a physical commodity trading company based out of Singapore. We specialize in chrome ore, vanadium ore, and manganese out of Southern Africa mostly. And our strategy is if it's a development stage to production stage, we invest in the form of prepayments or offtake agreements in exchange for product. And that has been our strategy for the past 5 years, and I think we're the 6th largest chrome trader on the planet right now. Yeah.
Hi, morning everyone. My name is YJ. I'm a portfolio manager at Arcane Capital. This is a fund based in Luxembourg. We invest in renewable energy, listed equities, so solar, wind, electric vehicles, lithium, the supply chains, all that. It's a very nice little fund, and later this year or maybe early next year, we are looking to launch a new fund in Singapore focused on metals that drive the renewable energy space.
Hi, good morning everyone. I'm Adhita Widiadhari, Senior Consultant from CRU. CRU provides business intelligence in metals, mining, and fertilizer industries. And in consulting, we provide tailored advisory, helping our clients' business development strategy, fundraising activities, and other corporate actions such as market entry strategy. Before CRU, I used to work in Indonesia for a state-owned mining company. Thank you.
All right, great. Thanks for those introductions. So, to get into kind of the
Piano again.
I mean, we are really talking about future-facing dynamics and the shift to sustainability. So it's, we're all trying to do our part. So maybe we can talk a little bit about some of the biggest risks and challenges for the mining industry today. So, growing ESG pressure, social license to operate, inflation, investment flows, global regulations on who can invest in which countries and which resources. So, how are all of these macro issues impacting or driving investment today? So what are you finding? Maybe Scott, if you want to kick things off.
Yeah, that's a lot of things.
It's a lot of things.
I mean, mining's a tough business. Doesn't matter if it's exploration or development or production. There's just a lot of things that can go wrong. And I mean, we're in the early stages of a global shift of governments prioritizing energy transition and decarbonization, which provides a real tailwind for a lot of companies with, grant money alone can really drive equity returns, for example, in a project. But the de-globalization piece is equally important, and I think, we are seeing a lot of duplicated supply chains, and so where are your deposits located, within which of those spheres of influence between the Americans or North Americans, Europeans, and the Chinese and Australians and everyone else. That's become more and more relevant as opposed to the world being a much more open place. I'd say there's headwinds and tailwinds really in the current environment. The tailwinds are that we will have massive. I think there's global recognition we need massive investment in a lot of these commodities to fill the supply chains. At the same time, it is getting more difficult to operate in certain jurisdictions. Like Mexico took away Ganfeng's licenses in Mexico recently, and we're sort of seeing a lot more nationalistic behavior in governments, compounded with the fact that they all racked up a lot of debt in the global financial crisis and the COVID pandemic, so they need money, and they'll tax companies that are making excess profits, which has always happened in the mining industry. You always get royalty increases when mining companies are making a lot of money. So I don't know if I'm really answering your question, because there's a lot going on in the industry, and I think you could put a positive or negative spin on it depending on the nature of your company. But certainly the complexity for investors is gone up quite a bit. There are a few more factors involved.
Anyone else want to jump in?
Yeah, well, in our case, okay, we look at all the macro ESG nationalism, especially because we operate mostly out of South Africa, and South Africa is an extremely dangerous jurisdiction right now. Not, I mean, in terms of crime, you get used to that, but in terms of how they're going to change the laws, taxation, etc., which, yeah, if a government is in need of funds, mining tends to be an easy industry to try and extract value from, especially from operating assets. But what we see as biggest challenge, as an entity who is constantly looking for new sources, we would call one of them would be a technological risk, i.e., do you invest in lithium? And lithium becomes obsolete in 5 years. Do you invest in a vanadium source, and 3 years down the line, the flow battery, it doesn't become the new norm for storage? Or do you invest in copper, and suddenly there is a much greater reserve that pops out of China? So that's the risk that we look at when we're looking at mining operations. That's why we took the strategy. You focus on a project which is either very close to production or already producing, because you don't know what's going to happen 3 to 5 years down the line. So even though we shouldn't be the standard investor we're like the worst investor in mining, because we have a very short-term view, but that's our view, 3 to 5 years. If project doesn't pay back with the current information you have in hand in terms of policies and technology, then you just don't touch it.
Okay, Amy, you asked a super high-level macro question, so I'll just give some thoughts on the big trends that we are looking at. So why we like this space, this entire mining ESG space, is because there are a few self-reinforcing trends out there. The last cycles of renewable energy have all fizzled out, simply because they were all mostly subsidy-driven, not really economic at that point in time. But right now, we are seeing renewable energy actually go below the cost of fossil fuel generation for electricity, for example. And so that's the falling energy costs are actually driving this entire move into the energy transition, right? And that is causing what we see as a super cycle, a long-term super cycle in these energy transition metals. So that and the EV trend, the EV mega trend as well, these are all what we see as self-reinforcing trends that actually make this space very, very interesting right now. The challenges, and that would be one of the tailwinds that Scott mentioned earlier, but the challenges, yes. Well, last year we saw a massive spike in the price of lithium, and supernormal profits come out of that industry. And suddenly, not just in oil and gas, now there's talk of windfall taxes going here and there everywhere. Yep. So those are the challenges. Yes.
Yep. I think having worked with miners, one of the biggest challenges for them is related to ESG issue. And today's miners are vertically integrated with downstream processing, which expose them to another environmental issues, such as tailing management. So it's still around that area of ESG, actually. And then this tailing management has been quite disturbing to the local community as well, making them hard to gain the I would say, the agreement from the local communities in terms of social license to operate. And then another thing that they're facing is how to stay competitive, given that more competition coming into the market, because these downstream producers wants to consolidate with the upstream business as well. And the drive on the technology making it cheaper for these guys to consolidate with the upstream. So they're studying ESG and cost competitiveness.
Yeah. Scott started to mention earlier about kind of the growing resource nationalism and de-globalization that's really kind of taken, it's really certainly caught on since the COVID pandemic, and I think new regulations are really just enforcing that. Do you want to give any sense of, you know, where you expect that trend to kind of develop further?
In terms of resource nationalism?
Yeah.
Yeah, it's you know, the world's moving into regionalized blocks effectively, and there's a North American block, there's a European block, Australia's fitting into the North American block, and then you have places like Africa where it's sort of up for grabs, and South America as well. And I think that, you know, governments, like I said, they need money, and they'll keep taxing profitable companies, and I think, you know, everyone realizes the strategic importance of these upstream supply chains, and increasingly want to have more downstream industry in their own country, and you know, retain more of the margin, which, you know, in my opinion, is not really going to work in most cases. You know, in Australia, for example, they just don't have the people with PhDs in chemical engineering to run these plants, you know, whereas China's been churning them out for, you know, years and years, and they're so far ahead technologically that if you're a company whose product, you know, depends on quality and you know, purity of supply and technological efficiency, you know, it's hard to take a chance on a downstream product that's come out of a place that doesn't have that type of legacy. So I think, you know, that's one interesting thing to watch. Everyone wants to subsidize downstream around the world, but I don't think it's going to work in a lot of places. And you know, as evidenced by the fact that both Ford and Tesla have CATL as their technology partner in their new battery parks in the U.S., and it caused a lot of you know, jawboning by U.S. politicians. The fact is that if you're Ford and Tesla and you want to have the best car on the road that you can, right now, you know, you can't get around using Chinese technology. So, you know, even in this, you know, de-globalizing world we're in, I don't think it's as simple as ripping the whole world apart. I think we're pretty interconnected, and until we see the rest of the world catch up to China and things like battery technology, they're going to be a part of the industry for the foreseeable future.
Yeah, I think there are some countries I would say can be very successful with this natural resource nationalism, de-globalization. Take Indonesia, for instance. I think they're quite successful with the downstream policy. They managed to bring investment coming into the country although they claim to be neutral, but we've seen a lot of Chinese investment coming in, especially in the nickel downstream value chain. So right now, I think outside China, they're now the biggest nickel supplier globally due to the success of this Chinese investment in Indonesia. And then going forward, they're looking at to process it further into downstream, like a battery cell production. Yeah, I think, Amy, it can be beneficial for the country because we've seen that mining sector only contributed around 7% for Indonesian GDP back in 2016, and nowadays it contributes around 12% at the end of 2022. So, and it has created a lot of jobs for the local people as well. But then again, it's not very popular for the global market because, of course, there's going to be a curtailment on raw material supply as an effect of that.
Oh, well, this resource nationalism and supply chain issue is actually a couple of trends moving together. One, like, like Scott and you mentioned, more governments want to keep the value added within the country. Yet at the same time, we have external influences like US and the EU wanting to lock up their supply chains, or rather develop a new supply chain next to the Chinese one that's already well established. And therefore, what we see going forward is a very, very interesting tug of war going on right now. There's one which is established, like I said, in China, and then one being built in the US and the EU. They are trying to duplicate what the Chinese already have, but at the same time, they are more expensive to build and they are more expensive to run. So so they're creating this high-cost supply chain that then, when they say then they cannot compete on the cost, right? And then they come and say, oh, the Chinese are dumping EVs on our markets right now, and this is what's going on back and forth right now as a result of all these.
I don't really, from our little point of view, I don't really see this as a tug of war, because if an American company wanted to go around and spend $1 billion buying assets in Africa, they could. If they wanted to go to Australia and acquire assets, they could. They just don't. I see that there is more investment in new technologies which would be beneficial. I mean, they're trying to find ways of extracting lithium out of mud in California, for example. There is investment into sodium-ion batteries, which don't actually require lithium. The US has no stainless steel industry. All the stainless steel is produced in China, but the US is able, by recycling the old steel, to maintain its competitiveness in what they do. So I don't really see this as a competitive tug of war. I think these are political statements that China is trying to take over the world. So yeah, you're the US, you can print money, you can acquire as many resources as you need. There's just not that much need for primary sources. And if you look at this whole nationalization, which is not nationalization, that's the wrong word. Government influences. Most of these government influences they do have a positive tone, right? Why would you extract 2% nickel, send it all the way to China, and the only people that benefit are just the miners that don't invest in infrastructure? Why not generate more value? So all of this, even though they end up being used very corruptively, and they do affect quite a few businesses in the short term, they do have a positive tone. So national protectionism of resources for the benefit of the country, if done right, is not a bad thing. So that's our view. And Indonesia has been doing it really well, right? When I used to work in Indonesia in 2010, when it was the nickel ban, and everyone was screaming, just ruined the business and people are starving. Yeah, but then a few years later, now you see Indonesia producing, I think the third largest producer of stainless steel, thanks to Tsingshan, and producing batteries, then moving on to producing scooters, right? I mean, it is short-term pain for long-term gain. If done right, actually works really well.
Absolutely. Just a note to our audience, we will take questions, so happy to take them as we go. If you have any questions, you can feel free to put up your hand, and one of my colleagues will come around with a microphone. Thought we could shift a little bit just to look at investment. So, there's been a bit of a maybe negative sentiment in the industry right now, saying, there's not a lot of project financing happening right now. Some of the banks are not necessarily investing as they previously were. So maybe we can talk a little bit about, what's happening with project finance. Do you see investment, continuing to move out of the market, or maybe coming in, but in different sectors? Whoever wants to.
I think I'll start with that. I mean, we haven't really observed the death of project finance, I would say, because we know some companies are still looking to go for project finance too. But I think it's just the object of the financing that is different currently. So they're no longer financing the mining activities, I would say. Rather, they do fundraising for the downstream processings to build smelters, to build refineries. So it's not really death, but then maybe with the global inflation right now, it's going to be challenging for the miners to secure a reasonable interest rate at this point in time.
Yeah, I'll agree with you that, I mean, it's going from mining investment. So project finance was mining investment and lending into mines, and that has proven to be a disastrous strategy for banks. Not only because of Basel III risk-weighted assets, actually it costs a lot more for a bank to lend $1 billion to a mine than lend to a real estate project. So yeah, there is this push towards the infrastructure side, but also what has proven, especially in the 2000s, is 2012, a lot of mining project finance just went to waste because those were projects which they had a big reserve, they all had a very similar product. Big reserve, big production, big dreams, they're going to build rail, they're going to build, and none of them actually came to fruition. So for the banks to focus into infrastructure, I mean, you're already backing an existing ecosystem. So there is the mining, there is the rail. So you're going to invest in the smelter, in the port, in the wash plant, in the ferrochrome mill, because you know that is actually going to be a project more likely to generate the returns that they show on Excel, rather than a mine, which usually doesn't. And also that is our approach. For us as traders, even bigger traders like the Glencos, etc., they would look at, very rarely they would go and invest in a reserve. They're going to say, I'm going to invest in the processing, because the money is not, for them, the money is not in the share price or in the big reserve. Their money is in that commodity, which is on a vessel and on its way to be turned into dollars, right? So that's it. So I actually propose this, the death of project finance in mining. So it shifted to project finance in infrastructure, because really that's where you want to be. You don't want to take that risk anymore.
Oh, that's an interesting view. Where I said, then I see another source of project financing coming up, and that's actually in peer companies. So specifically in the lithium sector, what's what happened last year, prices ran up so much, all the companies made huge amount of money. And we have companies like Pilbara sitting on $3 billion outright cash, and Albemarle coming out to bid $4 billion for Liontown. So these lithium companies, the big ones that are producing right now and have sold into the high prices of last year and actually this year, prices are still great. Even if they are down 60%, they're still great from historical viewpoints. they're still making 70% margins on today's prices, which are down 60%, right?
Yep.
So we are going to continue to see more and more of these peer companies which have a lot of cash start buying up high quality assets around them. And like you say, the banks are not great at investing in mines because all they have to go on is a DFS.
Yeah.
And it's not a great source of investing material, right? But the peer companies, the guys who actually own and run the mines now, they are fantastic investors in these assets. And yep, I think it'll be good to look at what they are investing in.
Yeah, maybe I'd just add, I mean, I don't think project finance is in that bad a shape. I mean, I think it is difficult for commercial banks. But I mean, you know, Macquarie will still come in and rip your face off on a debt deal on a mine. You know, there are still, you know, players that will do it. And what's, I think, happened is you have government-sponsored lenders that are filling the gaps. You know, in Australia, in the U.S., Canada, Europe through the multilateral development banks. Like, these guys are funding projects, and you know, they're coming in, and you know, and then you have the grant money in the middle that can really drive the economics. I mean, to me, the biggest issue in the industry is more the lack of funding on the exploration side, because you know, it's this market that's traditionally been funded by retail punters in Perth and Vancouver, and there's no, you know, there's no equivalent of a tech venture capital industry for exploration. Even though the metrics are about the same, you know, you put 20 bets in, you think one or two of them are going to pay off, and mining has never had that. And so you have all these junior companies with stranded projects that, you know, are extremely risky and may or may not pay off, but it's just very hard for these guys to get funding. They're constantly having to go back. You know, they become public companies way too early. You know, they should all be private companies, but they do because that's the only source of funding. And that's the biggest issue to me in the whole industry is that we need a better way of funding junior exploration companies. They just can't, you know, the money's just not there for a lot of these guys.
I mean, maybe we can continue on with that focus on, you know, how do the juniors get funding? So whether through these, you know, the government lenders, M&A, private equity, the traders, you know, where is the money going to come from for this, as you say, the much needed exploration that's needed in the industry?
Well, I think to me, there's got to be a new source, and other than retail, and you know, and maybe, you know, maybe it will be the industry. You know, you're seeing big resource companies set up venture capital arms to invest in new technologies that are relevant to their industry. You know, BHP Explore is a great example of a big company that's launched a pretty, you know, significant initiative in finding good exploration companies and helping them get up. So I think it's the most likely source of new funding will come from the larger companies in the industry, I would think, one way or the other.
No, I agree with that. I mean, 5 guys in Vancouver and a PowerPoint can't really develop a project as well as BHP. I mean, that's a fact. You need the resources, the know-how. Also, you need to have, it's a lot more complex to develop a project than many people on the exploration stage actually think, right? Well, I've got a reserve, I do a bit of drilling, I'm going to get a decent share price on the ASX, TSX, and someone's going to take it off. It's not that. It's dealing with supply chains. It's dealing with like doing your exploration in the right way. You have to be able to sustain loss-making mining for 3 years if you want to remove your overburden in a decent way, rather than digging as quickly as possible to get to the reserve. A junior tech company can produce an iPhone as well as Apple. I always use that example. So you'd rather invest in an Apple, and then maybe you're not going to get the 50 times returns that you expect, but you will get your returns, and they could be quite significant over time. Or you invest side by side, one of the majors. I mean, that's another way.
Well, I actually don't see a lack of financing for most of these companies. What's happening right now is, especially for the battery metal space, it's this vertical integration is going much further than in the past. So today you have car companies investing directly in people mines that produce lithium. This has never happened before, and it's just going to expand. So this is already another source of financing that we see going to new mines. GM putting 650 million in Lithium Americas before any product is out, before the mine is even built, for equity stakes and for the offtake contract. So what they're trying to do is, swap cash today for offtake tomorrow. And if car companies can do it, then I see other companies can do it. And of course, the biggest elephant in the room are the all majors, right? They are the ones with the most cash. They are the ones with the mining expertise. But it puzzles me today why they are not getting into this high return space in a big way. Is it just because it's counter to their current business, but they can't be that short-sighted, or I could be wrong. But yeah, there's a lot of money there, there's a lot of expertise there. They eventually one of them is going to make the decision to just, you know what, I'm going to go in and perhaps buy Albemarle, and that would start the whole thing going.
So, as investors, for the investors on the panels, what makes a project interesting for you? If you are actually looking at the junior space, as most of us here today are, what makes it appealing? What would actually make you look at a company twice?
Well, for us, it's very easy. It needs to be near production, ideally in locations with existing infrastructure, because, you might be looking at some amazing projects in the middle of nowhere, and there's an expectation, we're going to build infrastructure. You can't. I mean, you don't want to go for like a big reserve, which is in an unexplored area. You would rather go for a small reserve in area like in Australia, for example. Australia is very competitive because it has the rail, the ports, the local labor that can actually, if a project is there, then it's very likely the product can reach the port within 5 years, rather than a giant elephant project which has to build everything from scratch. As I preferred location is South Africa because of the infrastructure. And the other thing which we see as very interesting is the clear intention of the management to reach mining stage, not just exploration and sell-off stage. That we see a lot of that.
Well, I love this question. It's what I do every single day, looking at junior miners and what to buy, right? So right now, especially in the lithium space, there's an absolute wealth of opportunities. Everything is so smashed out, so bombed out. You can buy high quality companies really on the cheap today. And what then do I look for? I look for tier 1 assets, high quality, high grade, great location, great jurisdiction, supported by great management that want to deliver, like you said, not just explore and sell off. Management that has proven themselves in projects in the past, in other companies, having delivered a project from mine development all the way to production, first sales, and eventually operating the mine successfully. And more importantly, I make it a point to steer clear away from companies whose management are just so focused on promoting their own stock, and spend a lot of time on Twitter or X, as you might want to call it, pumping their stock, getting a lot of retail investors to jump in, making hype out of every little bit of news, and stuff that is just there to pump up the stock, and then you see them do a capital raise at twice the stock price it was 3 months ago, or worse, they themselves sell out their own stakes at that prices. Now those are the ones that I just steer clear of.
To the moon, man. To the moon.
To the moon, hodl, right? But yeah, so there are so many great opportunities out there. Even if this company has what they call a tier 1 asset, if management believes like that, behaves like that, I'm not touching it with a 10-foot pole.
Got it.
I would say critical minerals are still worth to invest in. Commodities like copper, nickel, cobalt are still going to be like very important in the future for the energy transition in particular. And then I would look at the law and regulation where they're operating in, because it's going to be easier, especially for administrative purpose, like getting all the license that you need to operate in that particular country.
Yeah, I guess I'd agree with YJ on most of what he said. It's well, I guess in terms of commodities, we think we're at the beginning of a super cycle across the board. So I think most commodities will have their day in the sun, and there's lots of reasons why. I mean, the industry's been chronically underinvested, and you have a lot of these sort of public tailwinds happening. So, I think, the battery materials have had a lot of attention, but a commodity like gold, we definitely see doing well. If you look at central bank purchases of gold recently and getting out of U.S. treasuries and gold in the sort of brick part of the globe, it's pretty significant. And, I think we are probably in an extended inflationary environment. So the fact that gold's held up where it has with rates where they are, I think is pretty supportive. Oil and gas gets lost and forgotten, but it's going to be with us for a long, long time. And again, the industry's been underinvesting, and there are some great opportunities in oil and gas. And unlike mining, you generate cash flow a lot faster. So it can be a little bit easier to get your head around as an investor, because you can see the money coming in a lot sooner than these long-term projects. And then in terms of the companies, it's always the people thing first, and we're mindful of that old Mark Twain quote, "What's a mine? It's a hole in the ground with a liar at the top." And so we definitely put a lot of stock in who is running the company, and if they've had a successful exit before, then that's someone we'll definitely be interested in backing. And jurisdiction as well. I think if you're in a tough jurisdiction, there's a lot of interesting deposits in West Africa, but that's getting harder and harder. Yeah, so if we see something in our backyard in Australia, that's just an easier thing to invest in for us in the current environment.
All right. Do we have any questions from the audience before we start to wrap it up with our last questions? We've got a question here.
Yeah, thanks for all the sharing. So actually my question is about the future. So there are a lot of crypto investment in the traditional industry, including art, including gold, now even the US Treasury bills. How do you feel about the crypto investment on the mining industry?
So you mean like laundering money for mining shares?
Yeah, so now the crypto market is going to boom again. So maybe it's money laundering, or it's just cheating on the money. But how do you feel about in the future crypto will be source of the investment for the mining industry?
All right, I'll tell you that because I don't want to be seen. We looked at this. We looked at tokenization as a potential source of funding. Tokenization is where you have an asset, or in the case of us, we have like a stockpile, and you basically break it into coins, and you do an ICO. And so that might be interesting. But the problem is, on one side, you have people who are actually investors in this space, investors, are expecting supernatural returns. So they wouldn't be attracted to the normal returns you would get from mining and selling of a commodity. And also the costs are actually very high if you want to do token. So in my view, if someone has, if there is money in crypto, it needs to be converted to like real money, which can actually be converted to project investments and equipment for that to make sense. And also, after looking at this for about a year, it proved to us it was easier for us to issue a normal vanilla bond with the backing of Absa Bank, like a 9% interest. Yeah, 9% interest seems high, but if you're trying to create your own currency, thinking that you're going to be printing money and go to the moon, that ends up being a lot more expensive than you think. And also you have to spend money on marketing. You have to spend money on like competing with all the other to the moon crypto. I don't see this as being useful in this industry in any way. And it's an interesting space on its own, but flowing into real economy as an investment tool, I see this very unlikely.
Well, Dinos, what you just described, taking an asset, breaking it into coins, and selling those coins. Now, if you change the ICO into IPO, that's exactly what shares are.
Yeah.
And that is the entire basis of the SEC going after the crypto, because they are just IPOs in another name.
Yeah.
And that's not going to fly in the real finance world. What we see in crypto, why we've never invested in crypto, is that it's a solution in search of a problem. And look, an asset has to generate cash flows in the end. An asset has to generate outside cash flow that isn't backed by new investors. Otherwise, that's called a Ponzi scheme. So if you do not have such a structure in place, a legal structure that protects its owners, then it cannot work. So if a mining company were to come out with a crypto solution or an AI solution, whatever the hype is these days, to me, that's a major red flag. I'm out.
Any other questions from the audience? Oh, we've got one here.
Thanks for those useful insights. Question, mine development project exploration is seemingly having very, very long timelines. Say in the case of copper, I'm seeing that from pre-feasibility, feasibility to getting the first ton produced, it can take well up to 10 years. Do you see this trend changing in the coming years? That's number one. And number two, what needs to happen to kind of shorten these project timelines?
Try. Yeah, it's hard to see it getting shorter in the near term. You know, the permitting process in most countries is still pretty onerous and you know, for good reasons, you know, environmentally in a lot of cases. And that's the big issue the industry has, that, you know, if you look at demand for copper and supply and how long it takes to get a mine into production, you know, the numbers don't work. And so, you know, I agree with Dinos, and I think there will be some technological breakthroughs in the next 5 or 10 years, you know, whether that's just more efficient processing of mines and tailings than, you know, has previously been the case. I think there'll be technology breakthroughs in terms of finding new deposits faster, more intelligently, and with the sort of environmental friendliness of mining production, which will help with the timelines on the permitting. But there's no silver bullet out there. We're sort of stuck with what we have, and at some point we'll get into a circular recycling loop, I think, for some commodities, and that will create a bit of a steady state, but you know, hard to, and there will be some substitution for sure of some commodities, but near term, I don't think it's going to change much.
Yeah, you're right. In fact, these timelines are not shortening; they're actually lengthening because of, like what Scott said, extensive permitting regulations, and these are getting more onerous as ESG comes full steam ahead, and you know, basically the Democrat side, the liberal / Greenpeace types get more of their say, and I don't know whether that is a good or a bad thing. It's a good thing for investors if you look from it from an investment point of view, that this would delay new supply into the market, therefore higher commodity prices, therefore higher returns on the miners. The flip side of it is that, yeah, it's going to delay the energy transition, what we really want to do.
Thank you so much.
So I thought we could kind of just wrap things up with, you know, a lot of the discussions that we're going to be having over the next 2 days are focusing on the energy transition and, you know, the future dynamics for the industry. So thought we could end with just final thoughts from our panel on, you know, where do you see the role for for investors, for government, in kind of helping to accelerate the energy transition or helping to essentially just enable it?
Yeah, I think investors will play a critical role in the energy transition because, as we know, it's not cheap to reach the global net zero ambition. So trillions of dollars will be spent annually just to get into that ambition. That's going to be where the investor role coming in to select the investments that are going to be supporting the ambition for the global energy transition.
Well, I guess as investors, we probably need to step up our game, really go deeper into this mining space and learn what is investable. What we see in this capital-rich pool in Singapore, where we don't have a single mine in the country, is that most investors are not investing in the mining space. Of course, they are listed elsewhere. The assets are elsewhere. It's an entirely new ecosystem, you know. So a lot has to be done there in terms of investor education, getting the large pools of the large funds and the large pools of capital to actually move into this space, convince them that the returns are high and likely sustainable, and hopefully, you know, move things in the right direction.
Yeah, I mean, my opinion is that investment should be left to the people that understand the investment. So even though we do investment ourselves, I would be more comfortable investing in a major mining company or major trading company that has a lot more information, know-how, and ability to bring value to these commodities rather than risk of betting on a junior. So, and that's our view. And actually, I think that's why BHP hasn't really invested heavily in lithium, if at all, because they have a very different view to the world. They've got like 20-year view instead of maybe it goes up, maybe it goes down. There's a lot of lithium on the planet. People that go into it from the junior side expecting super returns the next 3 to 5 years might end up being disappointed.
Yeah, I think for me, the best way to invest is through a dedicated fund manager like Tribeca or Arcane Capital. That's clearly the best thing that people can do with their money. That's what the smart money does. No, I think to me, there's all this government focus on downstream opportunities, but I think, you know, the real lack of investment is upstream, and that's what needs investment. And I think upstream and technology are the two things that I think investors can get the biggest bang for their buck. Playing in the downstream is difficult, and you have a lot of people that want the end product and the molecules who are going to fund that, and the governments are going to, you know, give the helicopter money down there, and they're all doing it to duplicate these supply chains around the world. So I think really the opportunities are upstream, and you know, until we figure out some new way of extracting things from the ground, that's kind of what we're stuck with. So that's where we would look.
All right, sounds great. So that pretty much wraps up this first panel. I want to thank everyone, our panelists, for joining us this morning to kick off the event, and the audience for participating in your questions. We are going to follow up with a presentation looking at different types of climate solutions for the mining industry. So if you don't have any meetings, definitely stick around, and we're going to just remove some chairs, and then we'll get started with that session. So thanks, everyone.